Today, the eyes and ears of the world are on Marrakesh for the release of the latest World Economic Outlook.
The global economy is limping along, not sprinting. Inflation remains uncomfortably high. A robust global financial safety net with a well-resourced IMF at its center is essential.
So our baseline advice to central banks is to hold the course, to continue tightening when necessary, to hold steady where appropriate, and to cut where appropriate, but always with an eye to get inflation back to target.
We can only succeed in a world of more frequent shocks by working together.
We are fully dedicated to the cause of supporting countries. We're trying to strengthen their institutions, their technical expertise, their human capital in every which way we can.
Hello and welcome to IMF Today. I'm Amanda Walker, and today a sign that global growth may be stuck in the mud. The World Economic Outlook is out, and it finds that growth is expected to remain slow and uneven. Just 3% this year and no better, 2.9% in 2024. Those are the weakest numbers since 2001. Shocks are holding back the recovery, including higher inflation and the war in Ukraine. There are also risks to future growth in the form of a slowdown in China's economy, rising food and energy prices, persistent inflation, debt distress, and greater geoeconomic fragmentation. But the right policies can help. Joining me now to talk about the report and those recommendations is the IMF's Chief Economist and Economic Counsellor, Pierre-Olivier Gorenchat. Welcome back to IMF Today. So, what are the headlines from this? What's your perspective?
Well, the first thing I would say is I would emphasize the resilience. So yes, 3%, only 3%, we'll come back to that. But let's remember the shocks we had in the last couple of years. Recovery from the pandemic, we had the energy crisis linked to the Russian invasion of Ukraine. We had this unprecedented tightening of monetary policy all around the world by hundreds of basis points over a year and a half, very fast tightening overall. Nevertheless, the global economy didn't go into a global recession. We have 3% growth. In fact, compared to April, the last time we spoke, we have 0.2 percentage point upward revision for the global economy. So we've seen a lot of resilience. At the same time, as you pointed out, 3% is still well below historical averages. I mean, it's not the lowest we've seen. We've had lower in the time of the global financial crisis or during the pandemic. But it's really sort of on the low side. And we need to have more growth if we want to address the challenges we're going to be facing.
So in that period since we last spoke, have you seen signs of hope?
Yes, we have seen, we've seen strong, we've revised upwards a number of countries. That's the second theme in our report, is the divergence. We're not seeing all the countries sort of marching at the same beat. We're seeing the US being revised up, very strong consumption numbers in the US, a lot of resilience in the US economy. 2.1% growth this year, slowing to 1.5 next year. We've seen higher growth also in Japan. We've seen higher growth in a number of emerging market economies, Brazil, India, Russia. But we've also seen downward revision. The euro area has been doing not as well as we projected back in July. There's a stronger slowdown there, 0.7% in this year, and then rebounding a little bit next year. We've seen also China being revised downwards. The real estate crisis in China is taking a toll on the economy. So it's a mixed bag. We see some countries doing better, some actually struggling a bit more.
Geoeconomic fragmentation, there are some risks highlighted there about the impact that could have on the green transition. Can you tell us more about that?
Yes, we have a whole chapter that is looking at the impact of geoeconomic fragmentation, so the fact that the world might sort of start moving in different directions on commodities trade. And in particular, we look not just at energy, but we look also at critical minerals that are going to be very useful, for instance, for the climate transition. And what we find is that there are growing signs that this sort of geoeconomic fragmentation is already taking place. We see, for instance, a lot of dispersion in the price of commodities that's surged. That dispersion has surged in 2022 and again in 2023. That's related to the sanctions, but also to trade measures that have been taken by countries. And then we ask ourselves, well, how much could this impact the green transition? For instance, if you can't get the critical minerals to produce the electric vehicles, the batteries, the photovoltaic panels, and we find that, you know, that could have a significant effect. It could, for instance, reduce the production of electric vehicles and renewable energy by about 30% compared to a situation where the markets would remain integrated. So that's quite significant.
And how do you think policymakers should respond, particularly in emerging markets, low-income countries who face those debt vulnerabilities the most?
Well, the first best would be to make sure that we maintain an open environment where, you know, these inputs can be traded and can go where they need to go. But bearing that, what we advocate for is maybe the establishment of some sort of green corridors that would sanctuarize the trade in some of these critical minerals or even food commodities, so that we can at least prevent the worst effects of fragmentation.
Pierre-Olivier, I know you've had an extremely busy day, so thank you very much for joining us.
Thank you.
Now, just moments after the press conference for the WEO ended, another started, the release of the Global Financial Stability Report. And one of the key questions was whether monetary tightening policies are working.
We have seen a rise in global interest rates, and that has been spreading around the world. At the same time, spreads relative to benchmark interest rates have been differentiated by the underlying riskiness of emerging markets and frontier economies. So more fragile countries, in particularly those with heavy fiscal burdens, have seen more of a rise in spreads than emerging markets that are viewed as being safer by markets. So quite a bit of differentiation, but a kind of orderly process. And many emerging markets were early in terms of raising interest rates and fighting inflation. So we see that it's really the emerging markets that are the first to also start cutting interest rates as the disinflation is actually more advanced in many emerging markets.
So I think just to emphasize the point Tobias made about the emerging markets having benefited from having tightened monetary policy earlier on in the global tightening cycle starting early 2021. That buffer compared to policy rates in advanced economies, specifically the United States, has allowed them to manage the inflation process in a way that is different from what we have seen from past global tightening cycles, and has shown that the asset class of emerging market in general has been quite resilient. Now that buffer is starting to erode, so spreads to US is getting smaller, or in some part of the emerging market world like Asia, actually they're becoming negative. So going forward, the advice is to emerging markets not to cut interest rate too aggressively because they could have negative spillover in terms of performance of equities, for example, or currencies.
Joining us for analysis of the fund's flagship reports is Martin Wolf, Chief Economics Commentator for the Financial Times. Martin, welcome back to IMF Today. So we've got the figures, the messages of these flagship reports. What are your takeaways?
Well, I've so far really only focused on the WEO, so I don't know about the Global Financial Stability Report, which I'm going to read thoroughly. I think the message is pretty clear, very well expressed, and I broadly agree with it. So I think, as always, it's an impressive job, extremely useful. The big message, of course, is that we got through the most recent bouts of shock pretty well. The system looks reasonably resilient, but there are some huge underlying problems, particularly for emerging and developing countries.
Tell us about those problems.
Well, the first and most obvious problem is that since this series of shocks began with the pandemic, their performance has been really poor relative to expectations and hopes. They've been far worse hit by this cumulative series of shocks than the high-income countries. You actually find the US is doing better than people expected in 2019 or early 2020, and now, but the poorest countries have been dramatically badly hit in terms of GDP, domestic demand, trade, everything. So domestic, all these things. And worse, we've also, as it points out, that we have World Bank evidence that shows a very large rise in the number of people in extreme poverty. The way I think of this is the convergence process in which the poorer countries of the world were getting richer on a per head basis than faster than the high income countries, and therefore the gap was slowly closing. That's reversed. We're not having that anymore. So this is obviously a colossal worry for policy, and particularly development policy.
So I was going to ask you generally about whether things have been more resilient than perhaps we were predicting a few months ago, but I'm guessing your answer is going to be that there is no generalization here.
Well, I think, as I understand it, to my mind, the forecasts haven't really changed.
Right.
So in that sense, the downside risks we were looking at in April, most obviously the series of financial shocks, the crises of these big regional banks in America, the closure of Credit Suisse. People were really worried we were going to see a big financial shock. Would inflation fall? And would there be a big recession associated with the reduction of inflation? These were worries, and WEO is really very optimistic on all those points, particularly the idea that we can get inflation down at these level of interest rates without a huge financial crisis, we hope, and without a really high unemployment. So in these respects, particularly in the high-income countries, things have worked out about as well as one could have possibly hoped 6 months ago, and that's very much the story of the WEO. It's the good part of the story.
Your latest book, you describe a crisis in democratic capitalism. Can you just tell us really, given where we are, what do you see as the role of the IMF and the World Bank right now?
Well, they are institutions based on the principles of rationality, expertise, globalization, a global view, all the things that we were trying to introduce after the Second World War, the world was trying to introduce. And of course, for precisely this reason, they're in the crosshairs of all the populists. So life for them is difficult, but they have to go on and do their jobs as best they can and hope they get the political support they will need.
Now, you are leading a seminar on domestic resource mobilization. Can I call that taxes?
That's a pretty large part of it,
all right.
but
So what can
there
we
are
look
a
forward
few
to?
other things.
What can we look forward to in this conversation, and why is it so important?
Well, the answer is fairly simple, and why it's so difficult, and not just so important. Public spending pressures are going to rise everywhere. Aging guarantees that, low growth guarantees that, and we also need to invest a lot more. I mean, it's clear, invest in climate mitigation, for example, and that will require inevitably, since you're not going to cut spending, higher taxes, or raising resources one way or the other in an environment in which people won't want that to happen because they want to keep their money to spend because they've got a cost of living crisis and other such pressures. So it's a hugely important thing, because if we don't do that and just increase our deficits, which is what's been happening, we do run, and this is one of the downside risks discussed in the WEO, the danger of fiscal crises, and that will be really devastating. It could create financial sector crises as well. So it's a central issue and a gigantic challenge, and I look forward to the panelists telling me how they're going to fix it.
Well, that's what these meetings are all about. What do you make of these meetings, Martin? It's not your first rodeo.
No.
It's been a while since it's been outside of the US. What do you make of the setup, the atmosphere?
Well, I've been to quite a few of these, but not that many, maybe this is the 6th or 7th. And I really love the way they've laid it out. I mean, this is quite different from anything I've ever experienced in this sort of outdoor tent arrangement. It helps, presumably, having sun. And that's been beautifully done. I like the layout. Everything's nice and compressed,
yeah.
and it's so different. And when one has been to so many of these things, usually huge hotels, something that is just different is fun, and I like it. So far, it seems to be working perfectly well, and I think it's going to be one of the most enjoyable ones. In addition, it has the non-trivial benefit that it's in the same time zone as my home.
Right.
So I don't, first time I come to an IMF meeting ever in which actually have no jet lag.
No. And you don't have to do those calculations of what time you can phone home.
No, I know. And I can even get up at exactly the same time as I normally do to write my columns this morning, and it worked perfectly because it was the right time. So I think it's just wonderful. You should do, I hope the fund will do more in this time zone.
Okay,
maybe Portugal next time.
I'm sure they're watching and listening, so please take note. Martin Wolf, thank you so much for your time. Now, the core of the IMF's work is really split into three areas: surveillance, lending, and capacity development. And limited access to financing is one of the acute macroeconomic challenges facing the African continent. It was a key part of a conversation on building capacity for Africa's economic empowerment amidst compound shocks.
And if we look at the part of the world where most of our money goes, about 50% of our capacity development spending goes, it is to the African continent. So we spend about $150 million a year on capacity development initiatives in Africa. So, it is absolutely central to the work we do in this area of capacity development, and Africa is absolutely key to it.
Morocco is also making a push for social development. Our host country established a special commission focused on it in 2019.
It had 5 objectives: prosperity, empowerment, inclusion, sustainability, and regional leadership. The focus was to make the structural changes needed to allow for stronger economic growth in a sustainable manner and a more inclusive and less unequal development. The Commission had several goals, including doubling the GDP per capita by 2035, ensuring that more than 90% of students have basic skills by the end of primary school, increasing the number of doctors per capita, increasing the rate of women's labour force participation by 45%, and reducing the share of informal unemployment to 20%. Overall, it seeks an overhaul of the social protection framework to boost human capital through steps like the universalisation of the health insurance system, the extension of unemployment benefits, and the development of an old age pension scheme.
This divergence of weak and uneven growth highlighted in the World Economic Outlook is hitting low-income and developing countries hardest. That's making it even harder for them to catch up to the higher living standards in advanced economies. For many countries, debt is one of the major obstacles to growth. Joining us now to discuss how to overcome debt and reinvigorate growth is Jayla Pazar-Bajolu, the head of the IMF Strategy, Policy and Review Department. Thank you so much for being here with us today. So when it comes to the debt issue, low income and emerging markets, how worried should we be about a systemic debt crisis?
So it's great to be here. And well, I think we are not yet worried about a systemic debt crisis. And that's because we already have 7 countries which are going through a debt restructuring process, and we have been supporting these countries. But what we are really worried about is what you've also heard earlier today, which is basically the reduced fiscal space that countries have, the funding squeeze that they are facing with much higher interest rates, with scarring from the pandemic, and therefore limited room to do the growth-enhancing reforms and the growth-enhancing investments that they need to make. So it's more of what may be coming our way and what we need to address, rather than an imminent systemic debt crisis in the short run.
So it needs to be tackled from within and also with help outside. So what would you say at this stage, what's the best approach from countries' own governments and from the international community?
Yeah. So in terms of countries' own, what they need to do is basically find ways of increasing their domestic revenue mobilization. And this includes fiscal actions, better taxation, dealing with loopholes, addressing the distortions, but also developing local capital markets, right? A lot of the domestic savings in many of the low-income countries and emerging market countries are actually going outside those countries because they don't have the instruments, they don't have the credibility sometimes to be able to attract even domestic savings, let alone foreign savings. So I think that's what countries need to do. Take the reforms in a way that would be increasing, enhancing growth. In terms of ways to increase the fiscal space, it's very important to do the governance reforms. It's very important to have a business environment that can increase investment, private sector investment, and so on. What the global needs are and what the global community can do is to support them in this. Institutions like us, in IMF, of course, the development banks, to really help countries and support them during the transition, because these reforms are costly. They're politically costly, they are socially costly. To support them to have the right targeted schemes to protect the most vulnerable, the social safety net, and provide the financing needed during that difficult transition as they do the reforms. There's also a need to help countries, what we started talking about, in terms of if they are at a stage where they need to do debt restructuring, to support them to be able to do that. And we have, of course, the Global Sovereign Debt Roundtable discussion on Thursday that we will bring the ministers and other stakeholders, and I can go on more about this if you would like, but that's an important part of the global response.
Sure, yes, tell us more.
So this is what the IMF has partnered with the G20 presidency India, as well as the World Bank, what is called the Global Sovereign Debt Roundtable. And the idea here is not to address individual country debt restructuring cases, those are better done at the creditor committee level, but rather look at what are the impediments that are causing a lot of these countries difficulties in addressing their debt restructuring issues, and try to get common understanding among the different stakeholders. So the Global Sovereign Debt Roundtable includes, in addition to the IMF and the World Bank and the G20 presidency, the Paris Club representative. It includes the US and the UK as deep capital markets representatives, so the ministers from those countries, as well as emerging market countries which are newer to the process, like China, like India, Saudi Arabia. We have also Brazil, which is taking over the G20 presidency, and of course Japan, which has the G7 presidency currently. As well as private sector participants, we have IIF, the ICMA. These are the institutional bodies for capital markets and also representing the banks, as well as BlackRock. We have Standard and Chartered, and the borrowing countries. So it is a 20-people roundtable where these issues are discussed in a very frank and open manner from the borrower's perspective, from the creditor's perspective, and try to see how can we reach some common understanding in terms of the bottlenecks that have been creating difficulties, be it some technical issues or be it broad issues like participation of multilateral development banks, which we reached a breakthrough last April. We will have the discussion, the ministerial level discussion on Thursday. We will then issue a progress report because we do want to explain to the world what is being discussed in these meetings and what has been achieved so far.
Well, as you've just outlined, these meetings are all about getting all the right people in one place. Are you confident that you can make some progress?
We've already made some progress, and I think that has also already reflected in some achievements in the individual cases. So if you look at the time it took from a staff level agreement in a country like Zambia, it was almost 11 months until the financing assurances was put in place and we could go to the board for the approval of the program. That timeline has declined to 5 months in the context of Ghana. So from 11 months to 5 months. In the past, it used to be 2 to 3 months. So hopefully we are making good progress, and the discussion at the stakeholders level is really helping individual cases to also proceed in a much more timely manner.
Taylor, thank you so much.
Thank you.
Now, looking ahead to tomorrow, the day kicks off with the Fiscal Monitor press briefing. We wrap up the latest of the Analytical Corner series and see the first of our governor talks. Our seminar series will also get into gear. The Managing Director and World Bank President will headline a panel discussing how climate policies can translate to action at the country level. Deputy Managing Director Kenji Okamura will also join a panel on how to finance resilience, growth and shared prosperity. And there's an event highlighting Africa as an engine of innovation. Well, thank you for joining us for this edition of IMF Today. If you're in the IMF headquarters or working from home in Washington, D.C. or any other offices of the fund right now, keep watching because we have exclusive content just for you. That's coming up in a moment, right after we share some of the best photos of the day from our brilliant IMF photo team. See you tomorrow.